All right, everybody, welcome back to the deep dive.
Yeah, good to be here.
We are talking about something today that I know a lot of our listeners are thinking about and probably a little concerned about, and that is the Federal Reserve and all the buzz around interest rate cuts expected in 2025.
Right.
It feels like we were at a really crucial point for the economy, and every decision the Fed makes right now seems like it has a pretty huge potential impact on all of our financial lives.
Definitely.
So to kind of break this all down, we've been spending some time digging through some analyses of the Fed's plans, especially with all this stuff about trade wars and these market corrections we've been seeing.
Hmm.
And there's this really interesting Bloomberg poll of economists that we want to get into because it gives us a sense of what the experts are thinking.
Yeah, absolutely.
And one of the big takeaways is they seem to be pointing to a couple of quarter-point interest rate cuts happening later in 2025.
Really interesting.
Yeah, so we want to really dive into what is the logic behind this move? What are the potential upsides of cutting rates, but also what are the arguments that maybe this isn't the best idea right now,
Right.
especially considering all the other economic stuff going on.
Yeah, for sure.
So to set the stage a little bit, can you just quickly summarize where things stand economically? What's the current interest rate and, what's the general timeline people are expecting for these cuts?
Sure. So right now, the Fed's benchmark interest rate sits between 4.25% and 4.5%.
Okay.
And the thinking is we won't see those rate cuts kick in until maybe September of 2025, and then maybe another one in December.
Right.
But there's this interesting wrinkle in all this.
Okay.
Even with these expected cuts, there's a lot of concern that inflation is going to keep going up.
Right.
Actually, the Bloomberg poll we mentioned found that two-thirds of the economists they surveyed think inflation is going to be even higher because of President Trump's tariffs.
Okay, so even with these cuts, it sounds like there's this fear that things are still going to be pretty expensive.
Yeah, I mean, that's the real challenge here. You've got this potential easing of monetary policy with the rate cuts,
Yeah.
but then you've got fiscal policy pushing in the opposite direction with these tariffs.
Right.
And if you look historically at times when you've had trade disputes and interest rate changes at the same time, well, you often see that the impact of the rate changes isn't as strong as you might expect.
Interesting. So it's almost like the tariffs are working against
Yeah, exactly.
the rate cuts.
Businesses are facing these higher costs
Yeah.
because of the tariffs,
Right.
and they don't know what demand's going to look like.
Right.
So even if loans become cheaper because of the cuts, they might not actually feel confident enough to invest and expand.
That makes a lot of sense. It's not just about the cost of borrowing.
No, not at all.
There's this bigger picture. And on top of that, we've got this stock market correction happening. The S&P 500's down over 10% since February. I mean, that's a loss of over $4 trillion in market value.
Huge.
And then you add in this potential trade war heating up again with a possible 200% tariff on European wines.
No.
Which, of course, has already triggered some retaliation from the European Commission.
Right.
So there's just a lot of uncertainty right now.
Definitely, it's a lot for investors to digest.
Yeah, and all this is feeding into this fear of what economists call stagflation, which is basically a situation where you've got slow growth and high inflation at the same time.
Right, a really tough combination.
Yeah, because anything you do to fix one problem, raising rates to fight inflation, could actually make the other problem worse.
Exactly. It creates a real dilemma for policymakers.
So I guess the big question is, are these rate cuts that everybody's expecting, are they really going to be like a lifeline for the economy?
Right.
Or could they end up backfiring with all this other stuff going on?
That's the million-dollar question.
Yeah, so let's start with the positive side. Let's talk about why some people think these rate cuts are a good idea. What are the potential benefits here?
Well, I mean, one of the most basic arguments, and it always comes up when we talk about interest rates, is that lower rates tend to stimulate economic growth.
Right.
I mean, it just makes it cheaper to borrow money, both for businesses who want to invest and for consumers who want to buy big things.
Okay, so on the business side, how would that work?
Well, cheaper credit could encourage businesses to expand their operations or invest in new equipment.
Right.
And our sources point out that this could be especially helpful for companies that are trying to adjust to all the disruption from these tariffs.
Okay, so if it's less expensive to borrow money, they might be more willing to retool their supply chains or whatever they need to do
Exactly.
to get around the tariffs.
And on the consumer side, lower rates mean things like mortgages and car loans become more affordable.
Right.
So when mortgage rates go down, you tend to see the housing market heat up. And when car loans are cheaper, more people buy cars. And, I mean, consumer spending makes up something like 70% of the U.S. economy.
It's a huge part.
So any boost to that can have a big impact.
Yeah, that makes sense. And it seems like another big argument for the rate cuts is that they could help offset some of the negative effects of this trade war.
Right.
I mean, tariffs make things more expensive for businesses, and lower interest rates could give them a little bit of breathing room.
Exactly. Cheaper loans could be a lifeline for companies trying to deal with supply chain problems and all the other headaches that come with trade disputes.
Right.
For example, if a company needs to find new suppliers because of tariffs,
Right.
having access to cheaper credit can make that transition a lot smoother.
Okay.
And our sources specifically mentioned the agricultural sector as a potential beneficiary here.
Right. I was just thinking about that. Farmers have really been hit hard by those retaliatory tariffs
Yeah, they have.
on American exports.
And lower borrowing costs could offer some much-needed relief for them.
Yeah, that makes sense. And we can't forget about the stock market either.
Right. The psychological impacts.
Yeah, all this volatility we've been seeing with that huge drop in market value that can really shape people's confidence.
Absolutely. And the hope is that rate cuts could help stabilize things a bit.
Okay, so how would that work?
Well, when interest rates are lower, stocks often become more attractive to investors than things like bonds, which are generally seen as less risky.
Okay.
So a rate cut could encourage people to put their money back into the stock market, which could help reverse some of that decline.
Right. And could this also help companies that are struggling with debt?
Yeah, definitely. Lower rates can make it easier for companies to manage their debt, especially debt they took on when rates were lower to begin with.
Right.
So it could potentially prevent some companies from going under.
So it's like a two-pronged approach,
Exactly.
helping out the real economy and also trying to calm things down in the financial markets.
Right.
And then there's this big concern about a recession, isn't there?
Yeah, I mean, our sources mentioned that like 70% of economists are predicting slower growth in 2025.
So a lot of people are worried.
Definitely. And the Fed might be looking at these rate cuts as a way to head off a full-blown recession.
So like a preemptive strike.
Yeah, exactly. We've been in this economic expansion for a really long time.
The longest on record, right?
Yeah. And the Fed might be thinking, let's try to keep this going as long as we can.
Right.
And when you consider that global growth is kind of sluggish right now, especially in places like Europe and China,
Right.
the U.S. can't rely on exports to drive its economy the way it used to.
Well, we need something to boost things domestically.
Exactly. And rate cuts are one way to do that.
Okay, so those are some pretty compelling reasons for cutting rates, but I know there are also some strong arguments against it.
Yeah, there are definitely some risks we need to consider.
So let's dive into those. What are some of the potential downsides of cutting rates right now?
Well, the most immediate concern that a lot of people have is that it could make inflation even worse.
Right, we talked about that earlier, but
Yeah, but it's a big worry.
prices are already high.
Yeah, and if you make it cheaper to borrow money, people are probably going to spend more.
Right.
And if that increased demand isn't met with an increase in the supply of goods and services,
Which seems unlikely given all the supply chain issues
exactly,
and the tariffs.
then we're likely to see prices go up even more.
Right, that makes sense. And then there's this scary sounding thing called a wage price spiral.
Yeah, that's a real concern too.
Can you explain what that is?
So if inflation keeps rising, workers are naturally going to want higher wages to keep up with the rising cost of living.
Right.
But then businesses have to raise their prices to cover those higher labor costs.
And then workers demand even higher wages.
Exactly, and it just creates this cycle where wages and prices keep going up and up.
That sounds bad, like a vicious cycle.
Yeah, it can be really hard to break out of once it gets going.
And then there's the impact on the value of the dollar, right?
Right, typically when a country cuts interest rates, its currency tends to weaken.
Okay, so why is that a problem?
Well, a weaker dollar makes imported goods more expensive.
Right, because we're buying them with weaker dollars.
Exactly, and that can add to inflation because we import a lot of stuff.
Yeah, that's true. And could it also lead to, like, investors pulling their money out of the U.S.?
Yeah, that's another risk. If investors can get better returns in other countries with stronger currencies and higher interest rates, they might decide to move their money elsewhere.
So it's kind of like a double whammy.
Yeah,
Weaker dollar, higher prices for imports, less investment.
exactly. And then there's this idea of a rate trap.
Yeah, that sounds kind of ominous.
The basic idea is that if the Fed cuts rates too much or too soon, they won't have much room to maneuver if the economy really takes a nosedive later on.
Right, so they're kind of using up their ammunition.
Exactly. It's like if your interest rate is already really low and then a recession hits,
Right.
you can't really lower it much further to stimulate the economy.
So it's important to keep some powder dry.
Right. And some people also worry that when money is really cheap, it can lead to some bad behavior from corporations.
Okay, what do you mean by that?
Well, instead of investing in things that will actually grow their businesses in the long term,
Right.
they might be tempted to do things like buy back their own stock
Okay.
or take on a bunch of debt,
Right.
which can be risky.
So it's kind of like they're not using the money productively?
Exactly. It can lead to a misallocation of resources in the economy.
Okay. And I've also heard this idea that the financial markets have become addicted to low interest rates.
Yeah, that's another concern.
Like they've gotten so used to these low rates that even a small increase can cause a big freak out.
Right. And it can also contribute to the formation of asset bubbles,
Okay.
like in housing or tech.
Right. We saw that happen with the housing bubble
Exactly.
back in like 2008.
And when those bubbles burst, it can be really painful for the economy.
Right. It's like a sugar rush followed by a crash.
Yeah, and then there's the impact on people who rely on fixed income investments, like retirees who have their money in CDs or bonds. Low interest rates mean they're getting much smaller returns on their savings.
Which isn't good for them, obviously.
No, it's not.
And then there's this whole other argument about something called moral hazard.
Yeah, this was a little more nuanced.
It's not as straightforward as some of the others.
Right, but it's interesting.
So what is it all about?
Well, the basic idea is that if the Fed cuts rates to try to soften the blow of something like President Trump's tariffs,
Right.
it might actually make it easier for him to keep those tariffs in place.
Okay, so it's almost like they're enabling him.
Yeah, some people see it that way. Like the Fed shouldn't be bailing out bad policy.
Right. And there's also the worry about the Fed's independence, isn't there?
Definitely.
Given, President Trump's history of criticizing the Fed.
Right.
If they cut rates now, people might think they're doing it for political reasons.
Exactly, which could undermine their credibility.
And then there's the fact that no one can really say for sure how all this will play out. I mean, trade wars are unpredictable.
Yeah, and inflation is tricky.
And the stock market as well.
The stock market is a stock market.
Yeah, exactly.
Oh, well, okay.
So the Fed has to make these decisions with a lot of unknowns.
Right, it's a tough job.
So how do you think they're going to weigh all these different factors? What do you think is going to be most important to them?
Well, I think the biggest wild card is what happens with the trade war.
Okay.
If things escalate even further, that's going to put a lot of pressure on the economy.
Right.
And it might force the Fed's hand.
Right.
But if there's some kind of resolution,
Right.
or even just a de-escalation, that could really change things.
Yeah, and then inflation is obviously huge.
Yeah, if inflation keeps running hot, the Fed's going to be really hesitant to cut rates.
Right, because that could just make things worse.
Exactly.
And then there's the stock market.
Yeah, if we see another big correction or a lot of volatility, that could push the Fed to act sooner.
To try to stabilize things.
Exactly.
And then we can't forget about the global economy either.
Right, if growth slows down in other parts of the world, the U.S. might need to cut rates just to keep its own economy afloat.
Right, we talked about that earlier.
And finally, our sources mentioned this thing called the dot plot.
The dot plot, yeah. What is that?
It's basically a forecast that the Fed releases every quarter.
Okay.
And it shows where each member of the Federal Open Market Committee thinks interest rates should be in the future.
So it gives us a little peek inside their heads.
Exactly. It can help us understand how they're thinking and what they might do.
Yeah, that's really interesting. So I guess the bottom line is that no one really knows for sure what's going to happen.
Right. There are just too many moving parts.
But it sounds like the Fed has a really tough decision to make.
Yeah, they do.
And it's going to have a huge impact on all of us.
Absolutely.
So I guess we'll just have to wait and see what happens. But in the meantime, I think it's important for everyone to stay informed.
Yeah, for sure.
And to think about how these different factors might affect their own financial lives.
Absolutely. Great advice.
So that's it for our deep dive today. Thanks for joining us, and we'll see you next time.
Yeah, thanks for having me.
All right, take care.
You too.
Bye.